If you're an American worker, you may have heard of 401k plans and are curious about how they work and how they can benefit you. In this video, I will explain what a 401k plan is, how it works, and the benefits of contributing to one. Thank you so much for checking out our channel. If you're interested in being part of this community, please consider subscribing to our YouTube channel. It's free, it doesn't cost you anything, and guarantees you will know when we release future videos. And to get notifications for when we do release those videos, definitely hit that little bell as well. Anyway, I'm glad you're here, and if you do find some value in this video, don't forget to smash that like button. So what exactly are 401k plans? A 401k plan is a retirement savings plan offered by many American employers. The employee who signs up for a 401k agrees to have a portion of each paycheck paid directly into an investment account. The employer may also choose to match part or all of the employee's contribution. The employee gets to choose among a number of investment options, usually mutual funds. A 401k plan works by first choosing to participate in your employer's plan and deciding how much of your salary you want to contribute each pay period. Now, as I mentioned earlier, your employer may match a portion of your contributions, which is essentially free money towards your retirement savings. You can't beat that. The money you contribute is invested in a variety of investment options, such as stocks, bonds, and mutual funds, and has the potential to grow over time. There are two main options for 401k plans. There's traditional and there is Roth. I'm sure you've probably heard of both, but maybe you don't understand what that means. With a traditional 401k, employee contributions are deducted from gross income before taxes are taken out, which reduces the employee's taxable income. No taxes are due on either the contribution or the investment earnings until the employee withdraws the money in retirement. With a Roth 401k, contributions are deducted from after-tax income, and there is no tax deduction in the year of the contribution. When the money is withdrawn during retirement, no additional taxes are due on either the contribution or the investment earnings. Now that I've distinguished between the two, let's talk about how you might contribute into a 401k plan as well as your contribution limit amounts. Employees can contribute up to the dollar limit set by the Internal Revenue Service, the IRS, to a 401k plan. For 2022, the annual limit on employee contributions is $20,500 for workers under the age 50 and $26,000 if a catch-up contribution is included. For 2023, the annual limit on employee contributions is $22,500 for workers under the age of 50 and $30,000 if a catch-up contribution is included. Employers may also choose to contribute to the employee's account, but the total employee and employer contribution cannot exceed these limits. Next, let's discuss how the employer match works for a 401k. Employers who match employee contributions use various formulas to calculate that match. Financial advisors often recommend that employees contribute enough to their 401k plans to receive the full employer match. I have to say, I definitely agree with them. Let's take a look at this example. Sarah is a 35-year-old who earns $50,000 per year. She decides to contribute 5% of her salary, or $2,500, to her 401k account each year. If her employer offers a match of 100% up to the 5% of her salary, Sarah will receive an additional $2,500 contribution from her employer each year. Over time, these contributions and investment returns can help Sarah build a substantial nest egg for her retirement. And again, we can't say this enough, it's super smart to take full advantage of that employer match if it's available. We've been knocking out a ton of information about 401k, so let's continue by answering a few more specific questions you might have about these plans. How do I make money with a 401k plan? You make money with a 401k by contributing a portion of your salary and allowing it to grow through investments over time. You can also earn additional money through employer matching contributions. How do I take withdrawals from a 401k? Generally, you can take withdrawals from your 401k once you reach the age of 59 and a half. You'll be required to pay income taxes on the amount you withdraw unless you have a Roth 401k, in which case you won't owe taxes on your withdrawals. What are the required minimum distributions, otherwise known as RMDs? Required minimum distributions, RMDs, are the minimum amount that you must withdraw from your 401k account each year starting at age 72 or 70 and a half if you reach that age before January 1st, 2020. The amount you must withdraw is determined by a special formula based on your life expectancy and the value of your account. As with a Roth 401k versus a traditional 401k, the main difference between these two types of accounts is when you get your tax break. The regular 401k offers it upfront since the money is automatically taken out of your paycheck before the IRS takes its cut, thus lowering your income tax bill for the year. You'll pay income taxes down the road when you start making withdrawals in your retirement. Contributions to a Roth 401k are made with post-tax dollars, so there's not going to be an upfront tax break, but qualified withdrawals are tax-free. Another upside to the Roth 401k is that unlike a Roth IRA, there are no income restrictions to limit how much you can contribute. The IRS allows you to stash savings in both a traditional 401k and a Roth 401k, which can add tax diversification to your portfolio as long as you don't exceed the annual maximum contribution limits of $22,500 in 2023 and $30,000 for those age 50 and older. What happens to my 401k when I leave my job? When you leave your job, you have a few options for your 401k account. You can leave the account with your former employer, roll the account over into a new employer's 401k plan, or roll it over into an individual retirement account, otherwise known as an IRA. Now let's get into this question that you might have been watching this video in the first place for. It's how do I open a 401k account? As is the case with almost any new job, it comes with a stack of documents to sign, initial, and months later, you try to remember where you actually put them. If you missed the meeting for the company retirement plan during employee orientation, definitely don't worry. Unlike some employee benefits such as opting in for insurance or setting up a flexible spending account, you can enroll in a 401k year-round, which is a pretty nice feature. The first step is to sign up if your employer hasn't already done it for you. Some employers automatically enroll new employees in the workplace plan, and all employers will do this starting in 2025 thanks to a Secure Act 2.0. Employers will start with a low contribution amount, such as maybe 2% of an employee's salary, and may even raise that amount by 1% annually up to a certain cap. In 2025, most employers will do this automatically unless the employee opts out. Step 2, choose an account type. Traditional 401ks are standard at workplaces, but more employers are adding the Roth 401k option as well. This part is really, up to you. I already discussed the difference between the two account types, so definitely go back and listen to that part. I personally am a Roth guy, but once again, it's up to you and may make more sense to do traditional based on your individual circumstances. Third step is to review the investment choices. The 401k is simply a basket to hold your retirement savings. What you put in that basket, the specific investments, is up to you within the limits of your plan. Most plans offer up to 10, maybe 20 mutual fund choices, each of which holds a diverse amount of hundreds, if not thousands, of investments. Maybe a market index such as the S&P 500 or the NASDAQ is what you're going for. Once again, the employer may choose a default investment option to get your money working for you right away. Most likely, though, it will be a target date mutual fund that contains a mix of investments that automatically rebalances, reducing risk the closer you get to retirement age. And that's a fine hands-off approach as long as you're not paying too much for the convenience, which leads me to maybe the most important task when opening up a 401k. Step 4, compare investment fees. Fees are the enemy of investment returns. If you review only one thing about your company retirement plan, make it investment fees, often called management fees, or maybe you've heard of expense ratios, and steer clear of any mutual fund that charges more than 1%. Participants have less control over plan administrative fees paid to the financial company that runs the 401k plan, but employees should still see how much it is. Some employers cover this fee, others pass some or all of it on to employees based on the percentage of assets each worker has in their account. Step 5, contribute enough to get any employer match. Even the priciest 401k plan can have some positive qualities. Free money via an employer match is one of them. Contributing enough money to get the match is the bare minimum level of participation to shoot for. Beyond that, it depends on the quality of the plan. Standard employer match is 50% or 100% of your contributions, up to a limit often 3% to maybe even 6% of your salary. It is important to note that matching contributions may be subject to a vesting period, which means that leaving the company before matching contributions are vested means leaving that money behind. The good news is that any money you contribute to the plan will always be yours to retain. Step 6, supplement your savings outside of a 401k. The IRS is so strong on individuals saving for retirement that it's willing to allow workers to save in multiple types of tax-favored accounts at once. Combining the powers of a 401k and an IRA can really maximize an individual's tax savings and future financial freedom. The ability to contribute to a Roth or traditional IRA is not just beneficial for workers stuck with a below average 401k. IRAs offer a lot more flexibility and control for all investors in terms of investment choices. Now, continuing right along, let's answer the question, what is the main benefit of a 401k? The main benefit of a 401k is the ability to save for retirement while also taking advantage of tax benefits. Your contributions are deducted from your taxable income, and any investment earnings grow tax deferred until you withdraw the funds in retirement. So the main benefit is a pretty big deal and one you absolutely want to take advantage of. That's pretty much everything you need to know about a 401k plan. Remember, the earlier you start saving for retirement, the more time your money has to grow. If you have any questions about enrolling in your employer's 401k plan or maximizing your contributions, be sure to consult with a financial advisor. Drop any questions or thoughts you may have regarding 401k plans in the comments below. Thank you so much for watching. Don't forget to like this video and subscribe to our channel, and I'll see you in the next video.